Good morning, James, and thank you very much to Andrew for that setup, and James to you for the invitation to speak today. Um,
Shall we sort of get going? If you don't mind, just sort of introduce the fund. I know a lot of people know it already, but if you just sort of tell us a bit about Trig and what it's trying to achieve, please.
yeah, absolutely, James. Look, Andrew said it pretty well. There's this overarching investment theme of energy security and energy transition. And then you couple that with investors' desires for inflation correlated returns and access in a liquid way to private market investments. And Trig really sits at the nexus of this, bringing those themes together. Trig is managed by Infrared and Res. So we have this dual manager structure, pretty unique in the investment company space. And in Infrared, you've got an expert investment manager. We've got 25 years track record in the infrastructure space. And it's great to have Res alongside us at the top table. They were there at the beginning of renewables. They've been in the renewable space for 40 years, and so a great partnership for Trig. Now, on this slide, we have an overview of what's in our portfolio, and we'll get into that in a bit more detail. What we have on the next page is what we have delivered so far. So we IPO'd 10 years ago. At the time, it was a 300 million IPO and have since grown the portfolio to 3.5 billion. A combination of strong support from shareholders through equity issuance, as well as a 9% annualized NAV total return. So our NAV over the last decade has grown 30%, and we've also increased the dividend over that time by 20%. Now, the share price TSR is lower given the recent share price performance, and that is something, James, you and colleagues at QuotedData have written on over the course of the summer. So on the next page, then we have the portfolio. So Trig's strategy is multi-geography and multi-technology, and being able to deliver new capacity as well. So if we start with the geographies first, our investment policy remit is Europe, and our split is, roughly speaking, 60% UK, 40% non-UK. And that really reflects that the UK has, over the last decade, led the way in renewables deployment. But being spread across geographies is a really important risk management tool. It allows us to be spread across different power price markets, across different political and regulatory regimes, as well as energy yield diversification as well. If you think we have projects in the northeast in Sweden, all the way down to the southwest in Spain. On the technology side, 80% of our portfolio in round numbers terms is wind. That really reflects also the fact that in Europe, wind has been the dominant technology that has been deployed. Solar, in round number terms, about 15% of our portfolio, and flexible capacity, about 5%. And by flexible capacity, we really mean anything that can respond to power prices. So in the first instance, battery storage, but it could in time also be hydroelectricity, maybe further down the line, if there's an appropriate business model, hydrogen as well. Now, solar and flexible capacity is somewhere that I would really like to move the portfolio forward in, just to improve the portfolio diversification further. Solar, I'd like to get up above 20 towards 25%, flexible capacity north of 10% in the near term. And then that really provides that balance with the wind that helps provide resilience to the forecast cash flows. Another important part of our philosophy on the right-hand side is making sure we're not overly exposed to any one asset. And you can see there, our top 10 assets are about half the portfolio, spread across geographies and spread across technologies as well. And our rule of thumb is usually no single asset more than 10% of the portfolio. Now, in the bottom left, we have something I think is really interesting. We have the opportunity to deliver new capacity. We have a construction and development limit of 25% of the portfolio. And that's really there so that we can balance making sure we service the dividend, but also create the opportunity for management alpha through the delivery of projects through development and construction. That's also really drawing from strengths of infrared and RES. The genesis of both of our businesses before Trig was IPO'd was very much in the development and construction space, and we're both still doing that. Infrared on private fund side and RES on balance sheet. In fact, in the first half of this year, we delivered 300 megawatts of new capacity, 4 solar parks in Spain and 1 onshore wind farm in Sweden. And we're also continuing to build out 2 more onshore wind farms in Sweden, as well as 2 battery storage projects here in the UK. So on the next slide, we can move on to the inflation correlation of returns. I spoke up front about investors' desire for that. Now, over the next 10 years, 50% of the revenues, over 50% of the revenues across our portfolio are directly linked to inflation through contractual arrangements. It's RPI or CPI in the UK and inflation index in France as well. And you can see there on the left-hand side, our inflation assumption versus that implied by UK gilts. And on the right-hand side, it means that if you compare us to index-linked bonds, then what the discount rate is telling you is a 5.5% real return with Trig versus 2% in UK government bonds. And clearly, with Trig being equity, we're seeking to outperform the discount rate, which is really a reflection of our base case. And we can get into that in a bit more detail. Now, we're conscious there's quite a focus on capital allocation. And on the next slide, we go into that in a bit more detail. What we've got on this slide is the picture for H1 from our interim results that we launched in August. But it's a similar picture looking forward as well. And we gave some views on that in our Q3 NAV announcement that we released last week. Now, our cash cover is healthy. You can see there before the repayment of debt, gross cash cover of 3 times, and after the repayment of project level debt, 1.7 times for the first half of the year. Again, expecting similar metrics for the balance of the year, and that's a very healthy place to be. Now, why do we quote it on 2 bases? Well, that is partly because different peers have debt in different places. For us, 80% of our debt is project finance. That means it's at the project level, secured on the individual or groups of projects. It's amortizing within subsidy periods, and it's fixed rate at about 3.5% on average across that debt. And that's 80% of our debt. The remaining 20% of our debt is our acquisition facility. That's drawn about 370 million, and we're looking to repay that or bring the drawings down on that promptly. In fact, just in Q3, we reduced drawings under our floating acquisition facility by 40 million, so about 10% of the borrowings. 20 million or so of that was from excess cash flows from the portfolio after having repaid project level debt, and 20 million was proceeds of divestments. In fact, in the quarter, we sold 3 onshore wind farms in Ireland at a 26% premium to where we were carrying them. So a really good result. And we use that to reduce our drawings under our construction facility. So I touched on, Trig is equity and the discount rate is the base case. So where could outperformance of that come from to continue to drive NAV forward? Well, we are highlighting 3 themes here. One is investing in higher returning investments, the ones we're building at the moment all have discount rates above the portfolio average of 8.1%. And the other is looking for opportunities where someone else might see more value in an investment than we might. Take the Irish projects that we just sold, for example. The buyer saw real repowering opportunities there, which we didn't have in our valuation, and resulting in a win-win for both sides. They take the repowering forward, we crystallize that premium for our investors. The next is development and construction, and I touched on the fact that we can take up to 25% of the portfolio into this. And that has two aspects. One is new projects, like the battery storage projects we acquired last year, where we complete the development, procure the kit, and then build it out. The other is actually organically created development and construction opportunities. So whilst we sold these projects in Ireland, there are 4 projects in the south of France, 3 projects in Northern Ireland that have repowering opportunities that we're looking to take forward ourselves. I spoke about the 4 solar parks we brought online earlier this year in Spain. Already we're thinking about, can we add wind to these projects as well? So really organic development opportunities. And then the third one is traditional value enhancements. There you can improve the energy yield. So for example, our colleagues at RES are busy looking for technical enhancements to improve the energy yield, particularly of some of the older projects. They can improve the aerodynamics of projects, for example, to increase energy yield by as much as 5%. They can also think about how can we better use computer software so that a wind farm operates as a collective rather than each turbine operating individually, thereby increasing the sum of its parts. And then the other piece is revenues and costs. Earlier this year, we secured an excellent corporate PPA with BT to enhance visibility over our revenues, but also the scale of Trig means that we can tender contracts together, make sure we have an appropriate scope of services, but actually improve costs as well, thereby improving return expectations without compromising on quality. So just to summarize on the final slide that we have here, there's 3 key themes driving returns. One is cash flow resilience. We touched on the strong inflation correlation. The fact that a lot of our debt is fixed rate means we have low sensitivity to interest rates on the cash flow side. And our approach to capital allocation is around disciplined de-gearing, balance sheet management, which will allow us to be more nimble as the market returns, as investment opportunities return as well. On the active management side, you've heard about some of the themes that we're looking at in order to outperform the 8% discount rate. And then portfolio optimization, making sure A, it's well positioned to manage risk, and B, we're increasing the return expectations from the portfolio. And there, just to come back to the setup we were given at the outset, energy security, energy transition is absolutely key and important. Lots of investment opportunities coming out of that, and also a tailwind for the sector. So an overview of Trig. I'm very happy to take questions.
Great, thank you very much, Minesh. I think it's very interesting. So we have got a few questions. Let's start with sort of big picture stuff first. So at the outset, you were saying we've got a mix here of onshore and offshore wind, solar, and sort of flexible battery sort of energy storage stuff. You've got the possibility to, I think, to put up to 20% in stuff outside of wind and solar.
Yes, that's right.
Is there anything else you might do beyond those things?
Yeah, and that 20% is very much there to reflect that Trig focuses on established technologies and looks for established business models. Over time, we have changed what has been in that 20%. So, for example, at IPO, offshore wind was in that 20%, and then it became a more mature sector, and we went back to shareholders to take it out. So that's the driver behind it. I think as technologies mature and come more within TRIG's ballpark, then we might look to take them out of that limit, but it is important there. On the emerging technology side, look, I mentioned on flexible capacity, hydroelectricity could be of interest to us. The challenge there is many of the projects of scale, often those that are battery-like in quality, in their quality, are often held by utilities and are strategic assets for them, so don't often come to market. But that could be one example of a more mature technology that we might look at. Plenty of technologies that we are watching. Hydrogen is one example. In fact, infrared in the development side of our business, RES on balance sheet are busy looking at hydrogen opportunities. I think for TRIG, needing more established business model, revenue structure would be really important before we look to bring something like that into TRIG.
Okay, thank you. With the new stuff you're doing, and you said that it's earning sort of higher returns than the normal sort of 8.1 on the rest of the portfolio. What sort of numbers are we talking in terms of where the discount rates are on things on construction?
Yeah, very good question. So a number of the battery storage projects we're looking at the moment that are at the development phase are double-digit returns. Certainly the ones we invested in back end of last year are high nines going into the tens, and these days you'd look to be into double digits. So you can see quite a good pickup from the 8.1% there.
Cool. Okay. And the debt financing thing, is that a constraint on you being able to, or people generally being able to develop stuff?
No, not for us. The projects we've just finished building and the ones we're building are on a pure equity basis because they have merchant risk. So our business case does not include levering those projects. Now, in time in the future, if we had merchant exposure, we may think about putting debt against that, but clearly the gearing of that would be much, much lower than if you had subsidies or fixed revenue projects. But at the moment, these battery projects, they're pure equity funded.
Thank you. Now, a lot of your sort of inflation-linked stuff is coming from the subsidies that were in place a few years ago, and obviously these roll off in time. Do you expect that the portfolio will still have quite a big exposure to subsidies going forward, or is that just in general decline?
Yeah, it's an interesting one. If we look at what the UK is, it's continuing to progress with CFD, contract for difference auction rounds, and those contracts are linked to CPI. You'll have seen in the last round of that auction, a lot of onshore wind and solar did receive contracts, even though it was unsuccessful for offshore wind. So those projects could create opportunities. Europe has also reinforced they're now looking to move more towards the UK style of CFDs. If that has inflation linkage, then clearly that would be a source for future inflation linkage as well. Albeit historically, Europe, for example, our projects in Germany have been nominal fixed rates rather than necessarily inflation linked. So we'd look to have a decent portion of the portfolio with inflation linkage, but equally, I've been talking about a lot of the projects we're building at the moment being merchant. Those are power price exposed, and we'd look to manage that power price in other ways, either through corporate PPAs, like we secured with BT earlier this year, or through portfolio construction using batteries and other flexible capacity to help manage our our overall power price exposure.
Okay, thank you. Now, we've got a couple of questions on this slide. So obviously these projects all have kind of fixed lives. Well, most of them do anyway. How much cash do you need to keep reinvesting in the portfolio to keep the NAV growing over time?
Yeah, you're talking about eternal life when you have a portfolio of fixed life assets. Our rule of thumb is a net dividend cover of 1.25 or so is what you need for eternal life, and to be able to invest in new projects at the same rate as old ones are coming off. Clearly, the current dividend cover, that's embedded now in the NAV. You saw a significant uplift in NAV through 2022. In fact, our forecast revenues across our portfolio, if we look at them today compared to at the start of 2022, are over 20% higher. And that went into a 10% increase in the NAV, as well as 150 bips increase in return expectations expressed by the discount rate. So at these dividend cover levels, yeah, absolutely able to reinvest at an appropriate rate. There have been periods where power prices have been low as well, and we've been close to one dividend cover. So there are swings and roundabouts, but overall, averaging at 125, that would be a good place to be. Also, just reinforcing that, we're making investments at higher return levels, which means that is also virtuous in terms of adding to future return expectations and cash flow resilience.
Okay, thank you. Can you talk a bit about how you sell your power and power prices generally, and the degree to which you can do long-term power purchase agreements, please?
Yeah, absolutely. So look, about half our power is being sold under contracts with governments, the CFD in the UK, renewable obligation certificates in UK, feed-in tariffs in France and Germany. So there you've got effectively a fixed price that may be inflation linked. On the balance, then you typically have a route to market power purchase agreement with a utility. Under that, you often have the ability to fix prices out, maybe up to 2 years, and we'll do that on a rolling basis to improve our cash flow visibility. But also, we have other tools at our disposal. So we'll participate in corporate PPA discussions. Like I said, we secured one earlier this year with BT. And we'll also use financial instruments. So on some of our solar projects, we have pay as produced financial instruments that allow us to fix pricing in. So we have a number of tools at our disposal, and we're able to pivot between them depending on where we see good value.
Okay, and where do you think power prices are going in Europe?
Well, our forecast sees them coming down to more normalized levels that we've seen historically over the next 7-8 years. The good thing for us is because we've got new capacity coming online, even as power prices come off, our overall cash flows remain resilient because just our generating capacity goes up. But there are risks in both directions to power prices. The conflict in Ukraine continues. The supply of gas through LNG is an emerging supply chain, and that is subject to disruption. And we've also seen a number of in the offshore space, particularly a number of projects being either kind of put on pause and slowing down the rate of renewables deployment. That's going to take a bit off the supply, and basic economics will tell us that will support the power price as well. On the flip side, you've got changing consumer behavior as well, so increasing demand as we electrify, but also smarter demand is likely to come, and at some point in the future, consumers may be able to respond to power prices as well, and that will have an effect. So, yeah, we forecast power prices to come down. We use a blend of three power price forecasters, and I've outlined things that could take it in either direction.
Great, thank you. Were we not in this sort of scenario where you can't raise more equity, would you have hung on to those projects in Northern Ireland and done that repowering yourself?
No, sorry, the Republic of Ireland.
Sorry, Republican, yeah.
Yeah, no, that we'd actually started that divestment process before the share price started moving as it has done this year. You can imagine these sale processes can often take 6 months or so to come to fruition. In fact, annually we discuss with our board divestments as well as investments as part of our strategy review. And at Infrared, our philosophy is very much seeking to extract best value across both of our listed investment companies. We have a strong track record of divesting investments where we think someone else is putting more value on it than we would from holding on to it. So it is part of our philosophy to look at those opportunities.
Do you think in the current market environment, though, you might actually ramp up the disposal program?
Yeah, we have a couple more processes on the way. I think part of it is making sure that we reduce our RCF borrowings. At just about 20% of our total borrowings, it's not a big feature of our debt, but if we can get that right down, then that gives us more dry powder and we can appraise new investment opportunities. And in that appraisal, we'll also think about buybacks as an investment opportunity as well. Whether to make a new investment in something at construction or development stage, say double-digit returns, versus buying back your own shares, effectively investing in your own portfolio, depending on where the share price is at that time.
Fair enough, thank you. You talked about adding to solar. Is that likely all be in Spain? Is it more attractive to do the solar in sunny countries, or will you look at other markets across Europe?
I mean, Spain has great irradiance, which is why it's succeeded so well deploying solar on a merchant basis. But solar is taking off in plenty of other geographies as well. There was a hiatus in the UK after subsidies were stopped, but you're seeing solar in the UK both win CFD subsidies, but also being built out on a merchant basis now that the cost of solar has come down. You're also seeing a lot of solar deployed in Germany and France as well, and there's even talk of solar in the Nordic region as well. So yeah, I think we would look at the full breadth, albeit I think in the first instance likely to be UK or Spain.
Okay, thank you. Obviously, generating renewable energy is great for the environment, but can you just talk a bit more about your general approach to ESG and sustainability, please?
Yeah, absolutely. It is through our DNA. In fact, our revolving credit facility is linked to ESG outcomes. The environmental piece is almost a given being a renewable energy investor, but the social side is equally important. If your local communities where your projects are based see you as a good neighbor, then that leaves you with less risk of site disruption, but also we're doing a lot of thinking around repowering, life extensions. Often that will need new planning permission. If you're seen as a good neighbor, a good tenant for a landlord, then that whole process should be easier and able to deliver more value for shareholders. So ESG absolutely entwined with shareholder outcomes. It's integrated throughout our entire investment process as well at Infrared, all the way from screening up front through due diligence and into the investment hold period as well.
Okay, thank you. Just one more thing to sort of go back to, because it actually came in quite early on, but we had this sort of scenario in the last auction round where nobody bid for any offshore wind, and then we've had projects that were secured in the previous round getting cancelled, and news about what's going on in the US. What do you think is going on in the offshore wind market, and what's the solution to what's been happening?
I think part of it is that governments have seen the price in the auction rounds come down so rapidly that they thought that was going to continue. So there was an element of expectation mismatch. On the other side, the turbine manufacturing sector is seeing, I think, what you often get with growing pains, which is a need to reset pricing to more sustainable margin levels. And you've had both of that come at the same time. We saw a lot of turbine manufacturers reprice their books back end of last year, and they need to kind of deliver their old order books and build up a new order books at the new pricing levels. So that's why I described it almost as a hiatus. I think a lot of these projects will still get built. Energy security, energy transition are both really important themes. It may just take a few more years to get there as the supply chain rebuilds and governments adjust their expectations as to where pricing might be.
Okay, thank you very much. I think we covered an awful lot of ground, Minesh, so that's been really helpful.
Thanks very much for inviting me on, James, and thank you to your viewers for their questions.
No trouble, and we'll be in touch again probably about a year's time to see how everything's going.
Great, thank you.
So we're back next week with Vietnam Holding. So originally these two were supposed to be the other way around, but we rejigged that. So slight apologies if there was confusion beforehand. All my fault. And obviously Andrew Hattie is not on next week again. I'm sure he'd be pleased to know. Yeah, we'll be talking to Craig Martin of Vietnam Holding next week, and then AVI Global the week after. So have a very good weekend, and we shall see you in a week's time. Thank you.